Welcome to another Woods Russell video blog. My name's Matthew Russell. I'm an expert in accounting, business and tax advice for small and medium-sized businesses as well as individuals, sole traders and partnerships. The topic of this video blog is property taxes and specifically the restrictions on mortgage interest that are coming into force. Through this blog I'm going to be looking at a couple of examples of how the restrictions on mortgage interests can affect you in two different circumstances, one not so serious and one very serious, and by the end of this video blog you will understand in greater detail how it's going to work in the coming years. As always, if you have any comments or suggestions, please get in touch with me. All my details can be found on the website at www.woodsrussell.co.uk. Right then, well, let's get to it then, and let's start the video presentation on property taxes, specifically the interest rate restrictions coming into force.
Okay, so in this blog I am tackling the changes to property taxes recently, and specifically the way that interest is treated, and the way that is changing. And this blog will be specifically relevant to buy-to-let landlords, and particularly those who have highly leveraged portfolios of housing stock. After watching this video blog, you should be able to understand how the restrictions being placed on interest relief can have a massive impact on the viability of your buy-to-let business. Okay, so let's get started then. So, the basics then. What is this restriction on interest? So, with effect from the 6th of April 2017, tax on interest relating to residential property is going to be restricted, so that only 20% of, so you only get a deduction for 20%. Essentially, this is 20% times the total mortgage interest. This is actually being phased into the tax system, so it's not going to be fully in force until the 2020 tax year. However, what a lot of people have failed to appreciate is that not only do you only get the 20% reduction of interest, it is disallowed altogether in the calculation of profit, and this can have some quite serious consequences on a level of an individual's profits, and it can even could potentially lead to the point where the amount they are paying in tax actually outstrips the amount they're earning from their property income. And to show you this, although not quite as severe as that, but to show you the examples of this, I'm just going to go through a couple of examples. I think that's the best way to explain how this will affect you. The first example is going to be a situation with a guy, someone who's got a single property that they put on their tax return, and the second example is going to be someone who has a much larger portfolio of properties, and they're the one that's going to really struggle. So, if we go through the first example then, so as I was saying, this is a simple situation where there's just one person who might have one buy-to-let property to supplement their income, whatever their main bulk of their income is. So we're going to assume for simplicity that this person's paying tax at the higher rate, so they're paying tax at 40%. So if we just put in the figures then, so first of all, this is their gross rent received. This is what they'll be receiving from their property, £10,000 a year. And you can see I've split it up into two tax years as well, 2016-17 tax year, and then the 2020-21 tax year, when these interest rate restrictions will be fully enforced. So then they take off the allowable expenses. So this could be things like repairs. Then also, this is the key bit, the mortgage interest coming in here. So let's say, assume for simplicity, that's £3,000 of mortgage interest. You'll notice that it's not included at all in 2020, and that's because it would be completely disallowed. Now that has the effect on profits for tax purposes then. So you can see that £3,000 effect on profits for tax purposes. Now that's for tax, and the reason it's for tax purposes is because in 2020 the the property owner will still be getting £5,000. They're still having to be paying that mortgage interest, but this will just be the figures for their tax return. So this will be taxed at 40%, and you can see the effect there. So the one final thing we have to put in for the 2020 year is the 20% interest rate relief. So the overall effect then for the tax liability, so you can see an increase in £600. So this is the example of a single property buy-to-let landlord, and you can see that increase in £600. While not ideal, you may just be in a situation where you just decide to pay it. You know, there's no real, really any other options. It's hard to justify with one property that it's a property buy-to-let business. So you've only got that one property there, and you might just suck the extra tax up. Now, note, however, that the profits after tax, are calculated using the 5,000, not the 8,000 figure. And as I was saying earlier, that's because this person still needs to pay the mortgage interest, even if they're not getting the tax deduction for it. And in the second example, we're going to see the true devastating effect that this can have. So in this example, we have a much larger buy-to-let investor who has a large property portfolio, say 50 or 60 plus properties, and has built up this property empire by leveraging their existing property assets. The main point here is to see how in this situation he's actually having to pay more tax than he's making money, and I'll show you that if we go through the figures we'll see that in true effect. So we have the gross rent received here, 650 grand, just to keep it simple, and then we have the allowable expenses, 250k in each year. Now the mortgage interest, 350k in 2016. Obviously it's not allowed at all for 2020, and again, this is not a ridiculous amount of mortgage interest if you're thinking of a buy-to-let landlord who's leveraged all his property to build up his property empire. So you can see the massive difference then in the profits for tax purposes here. In 2016-17 it's 50 grand of profits, but in 2020 without that mortgage interest it's a whopping 400k. And this has the several effects. Apart from a massive tax bill, you lose the personal allowance in 2020, and personal allowance is currently £11,000, and the way it's going, it could keep going up and up, so it could be a bit higher by 2020, but you'd lose that with that size of income, and you can see the taxable income therefore is much larger. We do still get the 20% interest mortgage relief, in 2020, which does seem quite large at 70 grand, but relative to the last example it's not really. And I've gone through the numbers. Obviously there's not enough space here to go through the complete tax calculation, so you'd have to take my word for it that the tax liability of this individual, well you can see there for yourself, massive difference, almost 100 grand in 2020. 2016-17 the tax liability is £9,200, so that is a whopping increase, and you can see how over a space of 4 or so years you're just getting hammered with this tax bill, and it's all there in the final figure, the cash profit or loss. So whereas we were making a 40 grand profit in 2016-17, we're now making a massive loss. So what this means in reality then is, we could have previously gone from a massive profit, quite happily chugging along £40,000 for our property business. Thank you very much. And now, just down the line, 2020, we're stuck. I mean, what can we do in this situation? It's very serious for the buy-to-let landlord. I mean, you have to do something. You obviously cannot stay in this situation. If you've what we've been doing with our clients is anyone that we know is in this situation, we've been talking to them, and we've already devised strategies to mitigate this. If you are in this situation, I very strongly advise you to speak to someone and get some professional help, because the consequences will, So it'll mean you have to sell your properties in the worst, just to be able to pay your tax bill. And if you're stuck doing that, you're going to be paying capital gain tax on those sales. It's going to be an absolute disaster for you, I think. So you really should speak to someone. But it's not all is lost. There are ways around this, and that's the good news. There are certain things you can do. I suggest you speak to your accountant or tax advisor about that, or indeed please speak to myself, and I'm more than happy to chat through your situation with you. So that's the end of the video blog. I hope you found it useful. If you have any questions or comments, as always, please get in touch. My details can be found on the website www.woodsrussell.co.uk, and I'm sure we'll be coming up with another video blog very soon. So thank you very much for watching.